Welcome to today's discussion. We're diving into the world of covered call ETFs, a topic that's generating a lot of buzz among income investors. Our guest is an expert in this area and will be exploring the realities and misconceptions surrounding these investment vehicles.
The allure of consistent income is strong, and covered call ETFs seem to offer just that. But it's crucial to understand the nuances before jumping in.
Exactly. Many believe they're a simple path to passive income, but is that truly the case?
Not necessarily. The simplicity is deceptive. There are significant trade-offs involved.
Let's unpack those trade-offs. What are some of the key facts and fictions surrounding covered call ETFs? So for our listeners who might not be familiar, can you explain what a covered call ETF is?
A covered call ETF invests in a portfolio of stocks and simultaneously writes or sells call options on those stocks. This generates income from the option premiums. The strategy is designed to provide a steady stream of income, but it comes with limitations.
Limitations being?
Primarily, the potential for limited upside. Because you're selling call options, your potential gains are capped at the strike price of the option. If the underlying stock price surges past that, you miss out on significant profits.
So the income is generated from the option premiums, but that comes at the cost of potentially missing out on substantial stock price appreciation. Is that a fair summary?
Precisely. It's a trade-off between consistent income and the potential for higher returns. It's not a get-rich-quick scheme. It's a strategy for generating relatively predictable income, but with a ceiling on potential gains.
And what about the risk involved? Are these ETFs inherently riskier than traditional stock ETFs?
The risk profile is different, not necessarily higher or lower. While the income stream can provide a buffer, the limited upside potential means you're more vulnerable to significant downside if the underlying stocks decline. Diversification within the ETF helps mitigate some of this risk, but it doesn't eliminate it.
So who is the ideal investor for a covered call ETF?
Investors with a conservative investment approach and a focus on generating income rather than maximizing capital appreciation. They should have a longer-term perspective and be comfortable with the trade-off between income and potential growth. It's not suitable for investors seeking aggressive growth.
That's a crucial point. It's not a one-size-fits-all solution.
Absolutely. It's essential to understand your own risk tolerance and investment goals before considering this type of ETF.
How do covered call ETFs compare to other income-generating strategies, such as dividend-paying stocks or bond funds?
Dividend-paying stocks offer a different risk-reward profile. They provide income but are subject to market fluctuations. Bond funds generally offer lower returns but are considered less risky. Covered call ETFs occupy a middle ground, offering a potentially higher income stream than bonds, but with more risk than many dividend stocks. The choice depends on individual circumstances and preferences.
Let's touch on the tax implications. How are the option premiums taxed?
The option premiums are generally taxed as ordinary income, which can be a significant consideration compared to the more favorable tax treatment of qualified dividends. This is a factor investors should carefully consider.
What practical considerations should investors keep in mind when investing in covered call ETFs?
Thorough research is crucial. Understand the underlying holdings, the option strategies employed, and the expense ratio. Compare different ETFs to find one that aligns with your investment goals and risk tolerance. Regular monitoring of performance is also essential.
The expense ratio is a key factor, isn't it?
Absolutely. High expense ratios can significantly eat into your returns, especially given the relatively modest returns often associated with covered call ETFs. It's vital to compare expense ratios across different ETFs.
How do market conditions and volatility affect the performance of these ETFs?
Volatility can impact both the income generated from premiums and the value of the underlying stocks. In highly volatile markets, the income might be higher, but the potential for losses in the underlying assets also increases. Conversely, in calmer markets, income might be lower.
Are covered call ETFs better suited for long-term or short-term investing?
Generally, they are better suited for long-term investors. The strategy is designed to generate consistent income over time, and short-term fluctuations can be less impactful in a longer-term context.
How important is diversification within the ETF itself?
Crucial. A well-diversified covered call ETF will spread the risk across multiple underlying stocks, reducing the impact of any single stock's performance.
Let's revisit some of the potential drawbacks. We've touched on limited upside, but are there other significant downsides?
Yes, the potential for capital losses if the underlying stocks decline significantly is a major risk. Also, the income generated might not always keep pace with inflation.
So to summarize, covered call ETFs can be a valuable tool for income-focused investors, but they're not a magic bullet. Understanding the trade-offs and carefully considering your own risk tolerance is paramount.
Precisely. They offer a potentially attractive income stream, but it's crucial to understand the limitations and potential downsides before investing.
That was a great discussion. Thank you for sharing your expertise.